Addison, we're kind of like out of time. There's things I want to talk to you about underwriting. We talked about a little bit about it, but what have you learned? You came on the Great Capital in the middle of the pandemic, 2021, right? You did your internship summer of 21?
Yep.
What's changed since then?
I mean, all sorts of things. I think from my own personal career trajectory and day to day, I don't want to say operations, but just kind of a day to day view. I think how much I worry about or think about when I underwrite deals has changed a lot, not just because of the macro environment, but just because of Great Capital as a company. When I came on in 2021 and into 2022, when we had third party management, it was just sort of like, well, I mean, this is how things cost, and you thought of things simply as a matter of per unit. And sadly, without having hands-on experience and a ton of prior knowledge, all you can really do is go off of internet guides that tell you payroll should never be more than 1,200 a unit, and until you start getting into the operations, realizing that like you can't always conceptually rely on that. So
Just being closer to the actual operations and the management just has shown you a lot of taking you out of the spreadsheets and shows you where kind of the rubber meets the road and the reality of how these assets are operated.
right. So I would say for particularly on the expense side, how things have changed a lot from 2021 to where we are today is there aren't, aside from maybe insurance, there aren't many things that I worry about on a per unit cost, because you can think about how things are budgeted for. And there's so many different ways where you can be detailed and really get into the weeds of what you'd plan for moving forward, that it's almost like your abstract per unit cost it's not to say it doesn't matter, but like that can't be your primary thought.
Yeah.
Like it's just not realistic to say we
it's
have
a
to keep
starting
repairs
point.
and maintenance to 400 a unit. Like I can't, it's hard to think that I was underwriting that way, or even thinking that way. And then also going to the rent growth side, I think from 2021 and 2022,
It's changed a little bit.
not just the level of rent growth, but I think there's always sort of a confidence of like, okay, you're below market, you'll just get back up to market. And now it's getting significantly more detailed as, okay, what does our property have and what does it not have? And then going into every comp around and figuring out like, okay, forget the market, but what is the real growth for this? And where's my actual movement? And it's allowed me, and I think just us as a whole, to be more confident, not just in the deals that we say yes to, but more importantly, the deals we say no to.
Yeah.
So I think those have probably been the biggest changes, is just knowing how things operate, because we're seeing it now and we're seeing it clearer than we were in 2021 and 2022. But I also feel like through having a better sense of how these properties run, almost having a comfortability of just knowing, like, on my underwriting or on projections, like we are going to be wrong in some way.
Mm-hmm.
Expense growth isn't always going to be a flat 3% or a flat 4%. There's going to be variability. There's going to be variability in rent growth. There's going to be variability in, like, what I had mentioned with lease termination fees. More so getting comfortable with just like, okay, but if we do miss the mark, how and to what degree?
Yeah.
I'm okay if going through a repairs and maintenance, all the GLs, and thinking, okay, but these particular instances at the property, these are all things that they couldn't have budgeted for, we couldn't have budgeted for. It's really hard to predict.
Yeah. But that's where you build in contingencies.
Right. And so I think that's probably, to kind of sum that up, the biggest is just knowing how the business operates, what you can control, what you can't control, and then building business plans off of that. And then I also think the best development to come out of probably this 2023, 2024, 2025 period, not just honing in on operations, but really having convictions on markets and understanding that, like, as everybody jokes, like the stock market just only goes up.
Yeah.
Knowing that, like, no, that's not always going to be the case. And I mean, you obviously understand that, but I think 2021 and 2022 gave a lot of people that thought it can only go up. And those are the people that are really happy about SOFR coming down.
Yeah.
But yeah, I would say just moving forward, I think that was the big adjustment, a much needed adjustment internally for me, is just like really honing in on the markets and almost, again, not really the markets you're saying yes to, but knowing what markets where you're going to face an uphill battle and it's not worth it.
Yeah. Yeah. It's much easier to flow down with the current than swimming against it.
So yeah, I would say that. And then also, I think from when I was on in November of 2022 and where interest rates had moved, there was always this, well, if interest rates move here, and these are where the cap rates are eventually supposed to go to. And now I feel like we're at a point where, like, okay, the cap rates are starting to get to where we need to go. But there's just some assets where it's like, I think they're always going to buck the trend.
Yeah. Yeah. There's been some surprising deals that surprise us to, lower cap rates than we would have really thought. And occasionally, I mean, there'll be some that'll be higher, trade at a big discount. But those are the deals that, that there's really no bid on. So just kind of prices keep going down.
Well, and also in this environment, exit cap rates, I think, have played more of a role in a good way.
Yeah.
I think 2021 and early 2022 allowed for a lot of people to just kind of say, like, well, this is where cap rates are going to be. And now I think there's the amount of deals I've seen come on the market that have been really surprising to me are deals where you have to do a value add. There's really no way around it.
Mm-hmm. You need to add revenue to get your NOI up to hit that number. But it's a big ask of, can you hit that number? Can you get that rent increase? You're going to spend the money. It sounds like a good equation. You'll spend $10,000, get a $200 a month increase, but is it going to cost you $15,000 or $20,000? But if you can only actually get a $500 or $50 bump, the math stops working.
Well, and to add some clarity of what I was kind of trying to elaborate on with who's in the market and who's not, some of those deals where your exit caps are so high, you then have to think of, okay, well, for you to make this work, you either have to find a way to get a line of credit, which, depending on your financing route, it's not going to happen. You have to be comfortable enough.
A line of credit on the acquisition
for your rehab. Yeah.
Yeah. Are banks offering that? I don't think we've asked for one for a while, but I'm curious if anyone's thrown it out there for you. Use the line of credit.
I mean, because we've been going agency, it's kind of that's just not going to happen.
Really haven't crossed the bridge in a while. But that's how we used to do a lot of all of our deals. We would get a line of credit for the rehab. We would get a bridge loan. We get a line of credit for the rehab, and then we roll it into a permanent. We do the work over 6 to 9 months, roll it into a permanent HUD 223F loan that fixed the rate for 35 years. It's great. Well, and HUD would basically take out the whole line of credit and the first loan, and a lot of the fees too.
But now where the market is today, if you think of either where the returns are going to be on a lot of these deals, if you go the agency route, which in a lot of cases is the most advantageous, you have to go agency, but then you have to find a way to fund that. You have to find a way to fund that rehab yourself, and it puts you in a return profile.
More equity means returns are going to go down.
And so in that return profile, it's like, well, it's not for groups like us. It's for these institutional groups. They're not in the market right now, or at least not in this market.
Not in the market, and often not always, but often they're not. They don't have the appetite for that kind of risk, that kind of project.
Right.
They want something new and shiny and stable.
So I can't emphasize enough the opportunity that's out there is it's great.
Yeah.
Unfortunately, it's just, are all parties aligned to really attack it?
Yeah. And the entry point's hard to find also, because sellers have certain ideas where pricing should be and what works for us. It's tough. It's tough to find.
It's not 2021 anymore.
It's not 2021 anymore. Well, Addison, you'll have to come back on the Great Report. It's a great episode. Thank you very much.
Thank you for having me.
Absolutely. Make sure you subscribe to the Great Capital YouTube channel. You'll be able to get episodes like this. You're going to be notified, especially if you hit that bell icon. And again, as I mentioned before, the Gray Capital newsletter, the Gray Report, it's the best multifamily newsletter on the market, but it's for free. GrayCapitalLLC.com/newsletter. It's packed full of all the reports that we went over today, all these things, and like 10 more. And sometimes there's even more on there, but it's packed full of stuff of everything you need to see, nothing you really don't need to see. It's highly curated, summarized to where it's like you can get pretty much the full lowdown and be up to speed, highly effective at your job, whether you're an investor, you're working for a multifamily shop, you're working in property management, you're just curious about the space. You're going to be high impact player armed with this kind of knowledge. And everyone's going to be like, how do you do this? And you're just going to say, I was subscribed to the Gray Report newsletter. And they're like, how do I sign up? And you can say, GrayCapitalLLC.com/newsletter. Thanks again for Addison to coming on the show. I'm sure you'll be back on soon. Stay smart out there, everyone. Make some good investing decisions. We'll catch you on the next episode of Gray Report.